Welcome to another S&P 500 analysis. This week, the S&P 500 continued to pull back. It came near one of the support level and appears to be holding that support. Does this mean the correction is coming to an end? In this video, we will analyze the S&P 500 price actions, the market sentiments, and its internals to see what they are telling us, whether we should expect more sell-off or get a shopping list ready. So far, the S&P 500 monthly candle for September is still holding above the August low and also making a higher high and a higher low. And that implies it is still in an uptrend on a monthly basis. Zooming in on the weekly chart for the S&P 500, we see it is in a one-time framing down. That's a change from the recent one-time framing up. This could be a sign of a trend change. The range for the week was 115 point or 3.36%. And for the week, it lost a little bit less than 86 point or 2.51%. And it is currently sitting a little bit over 52 point under the February pre-pandemic high. So that is 1.55% below that high. We see the 10-week and the 40-week moving average are still up. And the weekly price, the weekly close is above these two moving averages. And due to the one-time framing down, we'll consider the trend on a weekly basis is neutral. And before we continue to analyze the S&P 500 price action in more details and determine where it might be headed in the coming week, let's first take a look at the sentiments and the internals to see what they are telling us. Looking at the VIX, it peaked above the 30 level for a brief while, and then it came back into this 30 and 20 zone. But the more interesting development is the put-call ratio. See, the put-call ratio came back in above the 0.75 and closed the week at 0.7984, close to 0.8. So with the VIX in this neutral zone, and the put-call ratio is about 0.75. This could be a sign that the market participant are buying put and speculating there will be more downside to come in the market. The NYSE up-down volume ratio did expand to the downside a little bit when the S&P 500 moved down last week. The up-down volume ratio was minus 3.19 on Tuesday and minus 4.19 on Thursday. This week's reading are a bit more negative than the readings from previous week. And on the daily advanced decline, the daily advanced decline also show a bit more selling pressure with more than 2/3 of the stock trading down on the down days. For the New York Stock Exchange new high, new low, it is still remain positive, although it is small, but the new high did outnumber the new low. With this internal being so close to zero, it doesn't take much to see the new low overtake the new high when the S&P 500 enter a sustained period of selling. This internal is telling us to remain cautious as well. The NYSE cumulative advanced decline line continued to move lower as the S&P closed at a lower low. On Friday, we did see a small negative diversion between the S&P 500 and the AD line, so remain cautious. Moving on to the NASDAQ market, the up-down volume ratio moved modestly negative. We saw minus 2.28 on Tuesday sell-off and minus 1.8 on Thursday, minus 1.35 on Friday. The daily advanced decline also did not show a broad-based sell-off from the NASDAQ. It was minus 1,317 on Tuesday and minus 1,115 on Thursday, and minus 585 on Friday. These are not broad-based sell-off advanced decline number. We realize the magnitude of the NASDAQ index recent losses are mostly due to those heavily weighted large-cap tech stocks, such as the FANG stocks. But until we see a broad-based sell-off from the advanced decline, we should remain cautious. The NASDAQ new high, new low is getting very close to negative. On Tuesday, there were 5 more new lows than new highs. On Wednesday, it was plus 22, and on Thursday, it was plus 32. And on Friday, we see it was minus 2. So once again, the new high, new low continue to tell us to be cautious. The NASDAQ cumulative AD line is similar to the NYSE. It is making lower low along with the index. We should continue to monitor for positive divergence and remain cautious. So in summary, the sentiments and the internals did not change much from previous week. They are still showing signs of weakness and waiting for the ball to drop. Until we see capitulation selling and broad-based participation in the sell-off, we should remain cautious. Now let's analyze the S&P 500 price action to see what it did and where it might be headed. Last week was a shortened trading week due to the Labor Day holiday. We saw a continuation of the sell-off when trading resumed on Tuesday. It went down 2.75% on 94 points. Then on Wednesday, we saw a dead cat bounce and then followed by the selling on Thursday. And on Friday, 9/11, the market came back up to close with a small gain of a little bit less than 2 points, just to lead the market in a positive tone for 9/11. Switching to the 16-minute chart, we see the Wednesday price came up and filled this gap here. Then on Thursday, it came back down, and on Friday, it came down and tried to fill this gap near the 3318.14. Then it got a nice bounce near the close and closed just a little bit under 2 points of gain. Now let's go and take a look at possible scenario for the coming week. But before we do that, just a reminder, there are a couple potential market moving events for next week. There is the Apple product announcement on Tuesday, and then there is the September FOMC meeting on Tuesday and Wednesday. Then on Wednesday afternoon at 2 p.m. Eastern Time, the Fed will make its policy announcement. So beware of these events as they will likely create some volatility. I have a Fibonacci retracement from this high to this pivot low here. Okay, so I put in a Fibonacci retracement here. Let's take a look at the upside possibility just to prepare on a possible S&P 500 decide to reverse and bounces from here and to the new high. Then we essentially would be looking at this trend line as the first level of potential resistance. If we can get above this trend line and stay above it, then we'd be looking at this all-time high, 3588.11, back in play. But if it could not get up to this, get above this trend line, then we're essentially looking for this gap and this gap down here at 3284 get filled. So these two gaps at 3318 and 3284, these are the gap that we are looking for to be filled in the coming week. And in addition to that, if I move this measure 2 here, if it comes down to this 3284 gap and fills it, that's essentially in confluence with the 50% retracement. And that represents somewhere around 8.66%, so a little bit over 8.5% from the all-time high to the 50% retracement level. And that's within this, the 8% pullback. But if it fails to hold the support here at 3284 and move down to this 3200 level, which is also in confluence with the 618 retracement, and that would be near the 3203, then this essentially would be somewhere around, we put this down, about 10.8% of correction. So in a typical range of a correction between 10 and 15%, so this is well within the range of that 10 and 15% correction. So I'd be watching this 3200 level very closely for a possible reversal back to the upside. And of course, these gap level is important to keep an eye on. And we might get a bounce off the 50% level, after the 8+% of correction. That is also within the range of a typical correction. Now let's take a look at the other major market indexes. Right now, we're looking at the NASDAQ 100. You can see the NASDAQ 100 booked below this channel, and it came back up trying to back test it, and it failed. So right now, we essentially are looking for the possibility of the NASDAQ 100 coming back down to somewhere around this 10,313.94, which is also in confluence with the 38.2, 10,274.47. And the level of resistance will first we'll be looking at this trend line, and then it will be the all-time high at 12,439. So those are the potential resistance, and the potential support will be down here at the 38.2 near the 10,313.94. And looking at the Dow Jones Industrial, you see the Dow Jones Industrial made a couple attempts to try to get back above this trend line, and it failed to stay above that. So right now it came down and filled this gap here. So the first level of resistance would be basically looking at this trend line, then at this pivot high here at 29,199.35. And if we could take out this pivot high, then the all-time high could be back in play at 29,568.60. Now, for the downside, the potential support or these gaps here, these two small gaps at 26,924.78 and 26,525.68. Okay, so these are the two gaps that I'll be looking for as the initial support. And it can find support there, then I essentially looking for this thing to retrace back down to somewhere around the 25,000 level near this 38.2 Fibonacci retracement, and also this gap here at 24,781.84. And if it does get down to this level here, that would represent somewhere around 15% correction from the high. So that is also well within the range, 10 to 15% correction. The Dow Jones Transportation have been pretty resilient on the upside. It appears that it is on its way toward the all-time high up here at 11,623.60. And if we take a look at it closely, it's been pretty much making a one-time framing up, and that means making a higher low. Here, the potential resistance level, the pivot high at 11,359.50, and then the all-time high at 11,623.60. So those are the resistance level. And for the support, we're essentially looking at this gap fill here at 10,960, and also the trend line, and then possibly down at this gap here at 10,640.50. Now pay attention to the Dow Jones Transportation for clues where the Dow Jones Industrial will likely go. Finally, for the Russell 2000, the Russell 2000 continued to pull back from its recent high, and the potential resistance and support remain unchanged. We'll continue to watch this 1610.60 and 1698.90 as there's potential resistance, and also the 1461.30 and the 1355.80 as a potential support. This 1355.80 is in confluence with the 618 Fibonacci retracement at 1360.2, and that too, if it pulls back to this level, that represents a little bit over 15% correction from the recent high. So in summary, the market is trying to find a base for the recent pullback. With the S&P 500 already gave back nearly 8%, we could see another couple percent of pullback before the S&P 500 launches a possible reversal back to the upside. And this could bring the S&P 500 to near the round number level of 3,200. With the Apple event and the FOMC meeting next week, we could see the S&P 500 make that move down to the 3,200. Until then, the sentiments and the internals still flashing cautious signs. Therefore, we should remain cautious. Be sure to click the thumbs up to help me promote and share this video on YouTube. Thank you for watching, and stay safe.